Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about a topic that I've been thinking about for quite some time. Some podcast topics come relatively easy to me, and I know exactly what I want to say and the point that I want to get across. With this one, it was really a bit of financial analysis was required in order to determine, what the right outcome was. But also really just thinking about different clients, different investors, different situations and how they've worked out. So anyway, let me cut to the chase. The topic is really about, is it a good strategy to complete capital improvements to investment properties? Whether that's cosmetic renovations, complete rebuilds, or even, small developments like 2 or 3 townhouses, those sorts of things. So from a strategy perspective, is that a good strategy, or is it all just about the land? Buy really good quality land, hold on to it, don't do anything, don't spend any money on it. So, of course, as we know, the value of a property consists of 2 components. The land value plus any improvements on that land, which obviously the dwelling and so forth. Generally, because of supply and demand, land appreciates, whereas buildings depreciate over time due to wear and tear. And look, a building's not going to last forever, particularly, it depends on its construction quality, but I would argue construction quality is probably deteriorated to some degree over time. So if you go and build a new home, how long is it going to last? 30, 40, 50 years maybe? Well, is it going to be there in 100 years? Possibly, but maybe not. So it's not going to last for an infinite time, whereas land is just going to be there forever, of course. So we get to benefit from, it doesn't have a useful life. And of course, then as a property gets closer to the end of its useful life, the value of that asset depreciates, of course, because we can't enjoy it forever. Of course, it's possible to manufacture equity in property by making capital improvements, and that occurs when the cost of making those improvements is less than the market value improvement. So, for example, if I go and renovate a house, put a new kitchen and bathroom in it, cost me $100,000, it's quite possible or conceivable that the value of that asset has actually improved by, say, $150,000, thereby creating $50,000 of equity. So that's really manufacturing equity, if you like. And this is the strategy that I'm really wanted to consider and think about. Is it worth spending money on building value to manufacture equity? So let's talk firstly about the maths, then we'll get into the theory and then the analysis. So, as I said, the aggregate value of a property is the 2 components, the land value plus building value. Now, typically, if we make some generalizations, if we look at investment grade assets, typically if you go and buy a house or even an apartment in some circumstances in an investment grade location, you're probably going to get somewhere around a 60-40 split. So 60% is land value, 40% is building value. Now, if we know that the median house rate of appreciation over long periods of times, 30 or 40 years in most capital cities, is 7% or more. And we've just observed that. Now, whether it's going to be 7% over the next 40 years, no one really knows, but that's a reasonable number to work off. So, if a property needs to appreciate by 7% of its total value, then the land needs to appreciate at a much higher rate, because if the building's depreciating slightly over time, then the land value needs to more than offset that. And so I worked out that if the building is depreciating by 2.5%, let's say, which is the ATO's standard rate of depreciation on buildings. Now, whether that actually occurs and transpires is going to depend on lots of factors, including the building type, construction quality, etc. But let's just go 2.5%. Then if that part, so 40% of the overall value is depreciating by 2.5%, then the remaining 60%, being the land value, must appreciate by a little more than 13% per annum. So it makes sense, right? So if we look at it as an example, let's say our property's worth $100. So the building value is worth $40 and the land value is worth $60. So that building value of $40 will depreciate by 2.5% or $1 over the next 12 months, and that'll end up being $39. Whereas the land will appreciate by maybe 13%, so $8. So the land value will be worth $68. So 39 plus 68 is 107, being that 7% value appreciation. So from a maths perspective, in order to maximize your capital growth rate, your overall capital growth rate, what you really need to do is maximize the land value proportion. Now, these numbers are just examples, of course. It's just like a worked example of simple maths. But I bang on all the time about evidence-based investing, and that investing is simple, and that strategies should be able to be proven using basic logic and simple math. And this is an example here of why a high land value component property is important, because it drives overall growth or overall returns. And even if you disagree with my 2.5% depreciation rate for buildings, let's say they don't change in value, you've still got 40% of your asset actually not appreciating, and only 60% doing all the heavy lifting for the total asset. Now, of course, there are benefits associated with making capital improvements to property, and I thought we'd talk about them because, of course, it's not all bad news. Typically, if we go and renovate, rebuild, or develop a property, typically, and I underline that word typically, the value of the end asset is worth more than the cost to complete it. So that's why I said the manufacturing equity at the beginning of the podcast. Now, why does that occur? Why is it that if I go and renovate a property for $200,000, the value increases by, say, $300,000? Well, there could be a few reasons for this. Firstly, completing building works takes a lot of time, particularly now where there's a lot of delays in terms of finding tradies and so forth, and even the cost to complete now has been well documented, has increased. So there's a lot of work involved, not only in time waiting for the construction or renovation to complete, but also the owner has to spend time meeting with architects, builders, dealing with issues, all those sorts of things. And not everyone wants to go through that process. And some people are prepared to pay a premium to avoid going through the process, either because they don't want to get involved in a construction project, or they don't have the time. They want to move into a property that's ready. Also, building, making improvements, construction and so forth is not a riskless exercise. Things can go wrong, like cost blowouts, as I said, like we've seen through COVID. And sometimes purchasers will pay a premium to avoid this risk. Newly constructed and renovated properties are more marketable, so they tend to attract more buyer demand, and that can result in price appreciation as well. And then lastly, if we're talking about subdividing, so that is building one or two townhouses and subdividing into separate titles, what you're essentially doing is improving the marketability of an asset because it's more affordable to a larger pool of potential purchasers. So, for example, maybe there's only a handful of people that can afford to buy a house on 1,000 square metres, but if you put 4 townhouses on that block, there's a lot more people that can afford to buy a townhouse on 250 square metres because it's at a more affordable price point. And so that can create some value as well. A little bit like a stock or share split. They can occur just to really increase the liquidity and marketability of the particular investment. Now, while newly developed properties will command a premium typically, properties in disrepair will typically sell at a discount. And for exactly the same reasons that the premium exists for new properties, we'll discount it. We're buying some headaches. We know we need to develop. We know we need to rebuild or spend some money on it. And so typically, if you want to maximize your capital growth rate, what you want to do is keep your property in good repair, in good tenantable order, and in fact in a state that is commensurate with what a typical buyer demands for the type of property in the type of location that you own. Now, if we go and renovate or develop a property, it can give rise to a number of financial benefits or improvements. Now, the obvious one is obviously a higher rental yield. Renters will typically pay more for more accommodation, better accommodation. Renters don't really want to pay for land value. Land value is not really that important. I mean, the locality of the property, that's important to a renter, but apart from that, typically land value is not important. But a brand new kitchen, all the mods and cons, a well-lit living area with good natural light, etc. All those things are important to a tenant, and they will pay a higher rental yield for that. The second benefit is depreciation benefits. You can depreciate, if you spend money on a property, you can depreciate that asset. So capital works are depreciated at 2.5%. So capital works are really the structure. And then fixtures and fittings, which is referred to from a taxation perspective as plant equipment, is depreciated over its useful life. And the useful life for this sort of stuff like cupboards and cooktops and those sorts of things, and curtains and flooring, the useful life's really sort of 6 to 12 years. Typically it depends on the type of product or so forth. So, for example, if you spend $250,000 on a renovation, that might include $70,000, for example, on plant and equipment, and then the rest being $180,000 on the actual capital works, which is the structure. That will yield about $11,500 in a depreciation deduction. And remember, depreciation is a non-cash expense. You're not actually paying the physical cash out, but you get it as a tax deduction, so you get a tax refund. Now, I will underline, of course, the fact that, like we just talked about, buildings actually do depreciate. So yes, you're getting a tax deduction, and the reason you're getting a tax deduction is because your asset is worth less, or that part of the asset is worth less than what it was worth 12 months ago. Now, whether it's 2.5% or whether in fact higher or lower is going to depend on the type of property we're talking about. And the last benefit of making capital improvements is that manufacturing equity element, which is that once-off spur to capital growth or equity as a result of completing those improvements like I've talked about before. So the three benefits: higher rental yield, depreciation benefits, and potentially generating some equity in the property. Of course, there's a negative. The one big negative associated with making improvements is actually funding those improvements. And if we borrow to do that, which I'd suggest most people do that, even if they've got the cash, put the cash in the offset account. But if you borrow to do that, it gives rise to a higher interest cost, of course. And in a rising interest rate environment, that cost becomes higher and higher. So what I wanted to do then is do some numbers. I'm an accountant by trade, of course, and very analytical. And I like to get into the numbers, as boring as that sounds to my family members. And I compared three scenarios: a cosmetic renovation. The next scenario was a complete rebuild. So if you really got a really rundown property, if we build a new one, and then a small two townhouse development. So they're the three scenarios where we're making capital improvements to the property. And what I wanted to do is project out, taking into account all the outcomes, financial and otherwise, and work out, is there merit in any of these three strategies? And what I have used is specific properties. So whether they're personal or other investors that I know. So I've used these specific property assets to determine, how much would we need to spend, what is the outcome going to be from a value perspective and also from an income, rental yield and so forth perspective. So let's get into it. The scenario one is a cosmetic renovation. And so here I picked a single-fronted period house in North Fitzroy in Melbourne, which you could buy for $1.5 million and spend $250,000 on a cosmetic renovation. So new bathroom, kitchen, flooring, window coverings, paint throughout, etc. Not changing the floor plan. If we buy something where the floor plan is logical, so we don't need to go that expense. We're not going up in terms of putting another level on the property. It's really all cosmetic. The unrenovated property would have rented for $5 to $550 per week. And we estimate that the post-renovation rental income would increase to about $750, $800 per week. Now, the alternate to this strategy is to instead buy something that doesn't need renovating. So in the renovating example, we're buying for 1.5 and spending 250 on it. Well, instead of doing that, we could go and buy a house for 1.725, and plus stamp duties, etc., will equal exactly the same cost as the renovating. And we don't need to renovate it, and that would rent for about 600,000. So, as I said, 1.5 and renovate, or 1.7 and you don't need to renovate. Now, you'll need to refer the charts on the website, and links are in the show notes, of course. But essentially, the result is it's line ball. The renovating scenario is mildly advantageous over the first 9 years, mainly due to the probably higher rental income and depreciation deductions. But the stronger land value component of the 1.7 asset produces a better result over, say, a 15 to 20 year period. Because that compounding capital growth, the nature of compounding capital growth, it takes a while to kick in, but really it is very much line ball. So when we're looking at two examples, I guess two opportunities to invest in, and my gut feeling, to be honest, would have been the cosmetic renovation opportunity would have worked out better. Look, based on the assumptions that I've used, which again are based on a specific property, it's suggesting that they're not, and we don't need to go through the hassle of doing that renovation. But that was a bit of a surprising outcome. So no benefit there, no material benefit at least. Okay, let's look at scenario 2 then, which was the full rebuild. So purchase a rundown house on 800 square metres in Brisbane for $1.5 million. You could demolish that asset and build a new family home. And family homes rent really well in Brisbane. Build a nice family home with large living area and a pool in the backyard. It's a really attractive asset from a renter's perspective. So if we demolish that old house and built a 4 to 5 bedroom family home with a pool, the cost to build that's going to be around about 1.2 in current sort of costs. It's a bit inflated because of COVID. And the completed value of the asset's about $3 million. So really we've bought for 1.5, spent 1.2 on it, and we've got a little bit of equity because it's worth $3 million. The rental income will increase from $400 a week to here is we're taking a good high land value quality property and we're really creating significant building value, which is going to create a significant income stream. Now, of course, the alternative to that strategy is to go and buy the $1.5 million rundown house, rent it out for $400 a week and do nothing. You know, just live with the fact that you've got a dump on the property and you're not going to get a very large income yield. And instead of spending the 1.2 on a new construction, go and buy another asset for 1.1 million. And you're still spending the same money because the total cost of 1.1 will be 1.2 with stamp duties and buyer's agents and so forth. And so they're the two scenarios that I compared there. So the outcome of the analysis was over the first 8 years, the developing option, the build a new family home, produced a better outcome. And that's not surprising given the instant equity created. And I worked out that from a cash flow, an actual cash flow perspective, you're about $26,000 better off per annum as a result of doing that. However, over the long period, spending more money on land, a value appreciating land, produced a much better result. So over 20 years, 30% more wealth, or about $1 million in today's dollars. So $1 million, if I give you $1 million today, that's a big difference between the two strategies. And again, it makes sense because, the whole theme of kind of playing the long game, investing in land, and not worrying too much about short-term impacts. And the short-term impact here, the short-term sugar hit is the $26,000 of additional income, which of course is significant. But if I forego that and play the long game and put it all into land, then I benefit from that compounding capital growth. Okay, and the third scenario I wanted to look at was a small townhouse development. So building in a really good quality area, building a good quality product. So in this situation, and I use Melbourne as an example for this, I purchased this development site for $1.5 million, demolish existing dwelling and construct 2 townhouses for a total cost of 1.2. Completed townhouses will be worth 1.7 each, so 3.2 total value, and will rent out for $800 a week each. So $1,600 per week in total rental income, gross rental income. An alternate to this strategy, of course, is just to go and buy 2 investment properties for $1.3 million each. Total cost being $2.8 million, exactly the same as development option. So the outcome in this scenario was similar to the previous rebuild scenario, but not as stark, not as big a difference between values. So the development option was better over the first 11 to 12 years, again, because of higher income, higher depreciation benefits, etc., etc. But the buy and hold strategy, which is, just buy 2 $1.3 million properties, a high land value component, of course, produced a better result, about 16%. So remember, the total rebuild scenario is 30% better off. So this is half as good, 16% better off. $640,000 difference over 20 years in today's dollars. So again, if I put $600,000 in your pocket, you'd be pretty comfortable with that result. So it's really interesting to see, that a cosmetic renovation doesn't really have a big impact on, from a financial perspective. Making substantial improvements to a property certainly benefits in the first 10 years, but the alternate to spending that money on more land, buying another property or a larger land value component, produces a better net worth outcome over the long run, so 20 plus years. Now, one really important thing I would point out is that you can always renovate property down the track. I can always bulldoze and rebuild, I can always develop, I can always do those things. And I'm sure the cost to construct will increase over time, but I'm sure the land value will increase at a much faster rate. So it won't cost me twice as much to construct a property in 10 years, but that property or that land value could be worth twice as much in 10 years' time. So that's why I tend to counsel clients to invest most of their money, at least initially, in all land, as much land value component as possible, because you can always spend money on the renovation, on the building, on the improvements down the track. But what you can't change down the track is the amount of land you have, the locality and the orientation of that land, the shape of the block, etc., etc. So that's really where I would counsel clients to really spend their money. Now, of course, there's some non-financial benefits associated with developing properties. So as a kind of counter-argument to that comment, is that one advantage of developing, rebuilding or renovating properties is that you ensure you have a sustainable and desirable building style that will align with modern requirements. And this will ensure it appeals to tenants and maximise rental income, but also, and most importantly, if you plan to bequeath your properties, your beneficiaries may enjoy a higher quality or level of accommodation. So, if I'm buying some properties and I intend to give it to children or family members or whatever, and I know that they're going to use it for an owner-occupied purpose, for example, well, maybe they would prefer to inherit a relatively new townhouse as opposed to a very old style property. Just something to keep in mind. Not really a financial consideration per se, but again, something to keep in mind. And my final comment would be improving property is different from maintaining it. You're always going to have to spend money on maintaining a property. At some point, you're going to have to update the kitchen. Cosmetically, at some point, you're going to have to update bathrooms, repaint, recarpet, etc., etc. You're not going to get out of it. You're either going to accept a lower rental income or higher vacancy rates, so you can never avoid basic maintenance. You can always delay it, but you can never avoid it. So you need to do that. If you own a property for 20 or 30 years, you're probably going to have to renovate the bathroom, kitchen, coverings, those sorts of things, as I just said. That's prudent. That's basic investment management, I think, to harness as much value and income as possible, but quite different from what I'm talking about, which is really making capital improvements. Okay, so that's it for this week. It's a bit of a big one this week, and I hope you've got some value out of it. But essentially, buildings depreciate, whereas land appreciates. So as a general rule, the strategy should be buy the highest quality land possible, so the land that's in the greatest amount of, or benefits from the greatest amount of demand in finite supply. and then secondly, get as much of it as possible. Okay, that's it from me for this week. Until next week, bye for now.